6 situations it makes sense to refinance your mortgage. Maybe you've been thinking about refinancing and you're not sure if you need to. So, in this video, I'm going to cover 6 of the most common scenarios and the reasons why people refinance their homes. I'm Darren Tsai. I'm a licensed real estate agent and loan officer in California, and my channel is dedicated to real estate and mortgage education for home buyers and current homeowners to build wealth. Here's a list of the 6 most common reasons why people refinance. The first is pretty obvious. They can save money. The market has blessed them with lower interest rates, and they can lower their interest rate and lower their monthly payment. Second reason is more of a have to. It's usually a big life event like a divorce. So two parties own a home together and they don't want to own that home together anymore. So refinancing in that situation just puts one person on the mortgage. The third is changing the type of loan or changing the term of the loan. The fourth is eliminating PMI. The fifth is getting cash from the equity in your home. And the sixth would be consolidating debt. Before I talk a little bit more about each of those scenarios, I'm going to cover some mortgage basics so you can get the most out of this video. First, we're going to go over what equity is. Equity is just the portion of the home that you own. Equity is made up of your home value minus your current loan balance. An easy example here is your home is worth $400,000. Your loan balance is $250,000. So congratulations, you have $150,000 of equity. The next mortgage word is monthly payment, which is broken up into principal and interest. When you're making your monthly payment, usually a part of it goes to your principal and a part of it goes to your interest. Let's use the same example of your home is worth $400,000, your loan balance is $250,000, and your monthly payment is $1,500 a month. $1,000 of that $1,500 is principal. So every month your loan balance goes down by $1,000. And the other $500 a month that goes towards interest is the cost of borrowing money. Two more important mortgage words. The first is term, and that is just the amount of time you have to pay back the loan. The most common loan terms are 30 years and 15 years. And last but not least, we got adjustable rate. Adjustable rate just means that the rate changes over time. Most of you are familiar with fixed interest rates, so that means your interest rate is the same through the entire term, but there are also adjustable rate mortgages. And if you didn't know, a refinance just means that you're replacing your original mortgage with a new one. Now that we went over the basics, let's go a little more in depth on those 6 scenarios it makes sense to refinance. Before I dive into the things to consider before refinancing, if you have any questions about your home equity or mortgage related questions, go ahead and email me directly. My email's also in the description too. Okay, let's talk about some considerations before refinancing. The first, saving money. Who doesn't love to save money? A general rule of thumb many people use is when interest rates decrease by 1%, that's a good time to refinance. And another thing to consider when refinancing is the break-even time. What do I mean by break-even time? I'll use an example to show you. So your loan amount is $400,000. Your interest rate right now is 6.5%. And let's say rates drop down to 5.5%. And your closing costs, which are the fees associated with a refinance, it could be attorney, title, lender fees. So we have $6,000 in closing costs. You're looking at about $260 a month of savings. And so to figure out the break-even time it takes for those savings to catch up to the closing costs, we just divide that and it's 23 months. So a rule of thumb a lot of people use for this is if you can break even in less than 3 years, refinance then. Full disclaimer, the numbers in this video are just examples. They're just here for educational purposes. Now, if you are interested in getting a weekly update for current average interest rates, there's a link in my description and I'll email you every week with the national averages. Okay, so we've gone over saving money because rates are lower. Now I want to share 2 different refinance programs that don't require a full loan application. So these are for FHA and VA loans. And basically, because the government backs these loans, they've also made it easier to refinance them. And so the first is the FHA Streamline Refinance. And the amazing part about the FHA Streamline Refinance is that it has to have a net tangible benefit to the homeowner. So, and you might be wondering, what does that even mean? You have to potentially be saving on the overall interest over the life of the loan. So at the end of the day, this has to benefit the borrower. Some other great features of it, there's no appraisal or income verification required. So it's not a full loan application. Some other things to note with the FHA Streamline. You can't do a cash out refinance with it. It has to be your primary residence. You need to be in good payment standing, so no late payments in the last 12 months. And there has to be an FHA loan on the property currently. So if you have an FHA loan and you're looking to save some money, the FHA Streamline is a great option for you to get a lower monthly payment as long as you qualify. And the second one is the VA, Veterans Association, IRRL, which stands for Interest Rate Reduction Refinance Loan. And this is similar to the VA Streamline in the sense that it has to have a net tangible benefit to the borrower. There's no appraisal or income verification required, and it's only for existing VA loans. And you're going to need to verify your certificate of eligibility and occupancy. If you have questions on either the FHA Streamline or the VA IRRL, go ahead and email me. I'll drop my email in here for you, and I'll be happy to help you see if you can save some money on your mortgage. Now that we've covered those two great programs, let's jump back into these life situations where it makes sense to refinance. As I mentioned before, there are certain life events where you have to remove someone from a mortgage. And one of the only ways of doing that is refinancing out of that current mortgage. So a good example is divorce, right? Two people bought this home together and they went on the mortgage together. And now they've decided to split up, but they've agreed that one person can keep the home. But this other person doesn't want to be responsible for the mortgage. They don't want to have that credit tied to them, because if this person decides to stop paying, it's going to affect this other person's ability to buy a home and their credit score. So that one makes a ton of sense to refinance. So another very common scenario where you have to refinance someone off of it is related to inheritance. So let's say two siblings inherit a home. One of them wants to keep the home. The other wants to cash out. Many times they just agree to sell and this person just goes and buys a new one. But sometimes this person might want to keep the home. And so in this scenario, they don't have the cash to buy out their sibling. So what they do is they do a cash out refinance, and this sibling gets their proceeds and this sibling keeps the house. Keep in mind, these are general scenarios that we see a lot. Removing someone from the mortgage is not always the best financial decision, but sometimes it's made out of necessity. And I'm not saying it's the worst financial decision, because everyone's situation is the same, but a lot of times it's done because they have to do it. So the third time it makes sense for people to refinance is when they're switching from an adjustable rate mortgage into a fixed rate mortgage. Maybe they no longer want to have this uncertainty of their mortgage payment changing in the future, and so they just lock in a fixed rate, and now their expenses are fixed over the term of the loan. And it's also changing the loan term. So some people, it makes a ton of sense to move from a 30-year mortgage down to a 15-year mortgage. Maybe they no longer want to carry that debt for an additional 15 years, which will reduce the total interest paid over the life of the loan. This one isn't quite as common though, because even with a 30-year fixed mortgage, let's say you get a huge bonus one year, you can still use that to pay down your principal. So the 30-year mortgage versus the 15-year mortgage, it really depends on your specific financial scenario and your long-term financial goals. The fourth time it makes sense to refinance is eliminating PMI. So let's say you bought your home using an FHA loan and you put less than 10% down. That means for the entire term of the loan, you will have PMI, private mortgage insurance. One of the ways to remove that PMI is to refinance into a conventional loan. And when you refinance into that conventional loan, if you have 20% equity, then PMI is gone. And the fifth scenario that makes sense to refinance is you're sitting on a gold mine of equity in your home and you need to access a large amount of cash, but you're not sure how. So a cash out refinance allows you to get a new mortgage and pull some cash out. Before you take a cash out refinance, please consult your financial advisor to make sure that what you're going to use that cash for makes sense with your long-term financial goals. Here are some common reasons why people will do a cash out refinance. They want to fund their home renovation. They are paying for college. They're paying for new investments. They're starting a business. There's tons of reasons why people will do a cash out refinance, but make sure it makes sense with your long-term financial goals. And so the last time it makes sense to refinance is debt consolidation. Once again, I don't recommend this for everyone. I do always advise talk to a financial advisor before you make any of these decisions, but debt consolidation basically takes these high interest rate balances, right? Maybe a credit card that's looking at 20% interest, or personal loan that's looking at 13% interest, maybe an auto loan that's looking at 15% interest, and then you're consolidating those into your home mortgage. And so the reason behind why this could make sense is the interest rate on the home mortgage is so much lower than all of these other debts. And once again, make sure you're talking to a financial advisor before you go with this debt consolidation path. And if you don't have any of these high interest rate debts, congratulations, keep doing a great job with your credit. But for those of you that don't, this debt consolidation could be an option for you to save on that monthly payment. And before you refinance, I want you to think about a couple things. The first is closing costs. So there are going to be fees associated with refinancing a mortgage. Some lenders will tell you that there's a no cost refinance. That is incorrect. And some lenders might hate me for saying this, but they're taking the cost of your refinance and rolling it into the loan balance. So that means you're actually paying more interest over the life of the loan, but there's technically nothing out of pocket right now. Make sure before you refinance, you calculate your break-even point and make sure that it makes sense for you. Another thing that you want to make sure you do before you refinance is check out your credit score. Make sure you know what's going on with your credit score. A higher credit score means lower rates and lower fees. Also, before you refinance, make sure you know why you're refinancing. What are you going to use the funds for? Or are you just doing a refinance to save some money? So map out your long-term financial goals and think about how a refinance makes sense in terms of the overall financial goals. So I just shared the common reasons why people refinance. Now, those are pretty general scenarios. This video is just education. I don't go into specifics on each of those, but overall, here's those 6 again. The first is lowering your interest rate to save some money on your monthly payment. Second is you need to get someone off of a loan. Third is you want to switch from an adjustable rate mortgage to a fixed rate mortgage, or you want to change the term of the mortgage. Fourth one is eliminating PMI from your mortgage. Fifth one is pulling cash from the equity in your home. And the last one would be consolidating debts into one payment. So I hope you learned something in this video and it was valuable for you. If you want to stay up to date with current interest rates, you can sign up for a weekly newsletter where I just send you the weekly interest rate updates. As always, thanks for watching the video. I hope you achieve your long-term financial goals.